My name is Alex Farina, and I'll be presenting the Business Strategy Game ScreenCast on the A Company. A Company's mission is simple: provide a high-quality, successful shoe product that differentiates itself from the competition using the best materials in a way that has fair prices, competes in a global market, while increasing earnings per share, return on equity, stock price, credit rating, image rating, corporate responsibility, and celebrity appeal. A focused differentiation approach was implemented by the company in order to accomplish this mission. In general, a focused differentiation approach strategy concentrates on a narrow buyer segment or market niche and intends to outcompete rivals by offering niche members customized attributes that meet their tastes and requirements better than rival products. In general, there are 5 specific conditions in which a strategy will be attractive. First is the target market niche is big enough to be profitable and offers good growth potential. The next is industry leaders have chosen not to compete in this niche, and it is costly or difficult for the multi-segment competitors to meet the specific needs of niche buyers. The industry has many different niches and segments, and few, if any, rivals are attempting to specialize in the same target market, which is a condition that reduces the risk of segment overcrowding. There are also some risks associated with this approach. One is the chance that competitors outside of the niche will find effective ways to match the focus firm's capabilities in serving the target niche. A second risk of employing a focus strategy is the potential for preferences and the needs of the niche members to shift over time. The third risk is that the segment may become so attractive that it is soon inundated with competitors. During years 10 through 12, A Company had internet prices that were declining slowly in order to attract more customers to the product, with prices ranging from $75 to $70. The SQ rating was increasing at a steady rate, rising from 5 to 5.5 over this time frame, and wholesale prices were increasing slightly from $48 to $52. A Company was right on track with other companies while meeting investor expectations. Things took a turn for the worse, however, in year 13, when there were some decisions that backfired greatly. During year 13, there was a shift in pricing as well as materials that were used. As a result, EPS had dropped to a market low of $1.02, ROE plummeted to 4.2%, stock price sank to $16.10, and image rating dropped to 65, only to fall short of the benchmark of 70 again in year 15. The heart of the issue came in year 13 when, in order to increase all the major metrics, wholesale price was greatly increased to $70 per pair in both North America and Europe, African markets, while the price was increased to $60 in Asia Pacific and Latin American markets. Utilization of private labels was found to be one of the most important aspects of A Company's success, and once that was lost, the sales had shifted purely to internet and wholesale sales, which the company did not benefit as much from. As a result, focus has now shifted towards internet sales and various different advertising campaigns via the internet. A Company feels that the more that they can advertise, the better chance they will have in getting these private label sales back in order, as well as with a lower wholesale price, the company can price out other competitors. A Company intends to further increase the internet market share in order to do this. To gain better internet support, A Company will employ a best cost provider strategy. These strategies stake out the middle ground between pursuing a low cost advantage and a differentiation advantage, and between appealing to the broad market as a whole and a narrow market niche. This permits companies to aim squarely at the sometimes great mass of value-conscious buyers looking for a better product at a better price. Looking back, this strategy should have been the one that was put in place initially, other than a focused differentiation approach. A Company should have had better insight into what other companies were likely to do, with most CEOs fairly new to this process. Instead of going all out in one direction, A Company should have taken better care of itself by looking at what other companies were doing so that wholesale and private label sales would not have been lost. Overall, A Company is optimistic that it will come back as a global footwear competitor in the near future.